professional poker players play 15 to 20% of the hands. They wait for their spots, and then when they get a good hand, they bet big.
Yeah.
And the amateur poker players, they play every hand, or they play 70, 50, 60, 70% of the hands because they like to play.
Right.
But you shouldn't do that. You should only play when you have the cards, or you should only bluff once in a while, right?
Yeah.
And so I think if I had to say one of the biggest mistakes in trading that at least I know of and that I see other people is they just trade too much.
Okay, traders, what's up, guys? Welcome back to the Top Trader channel. It's your head trader here, Cleveland Bishop. Today is an interesting day. I'm excited again to introduce you guys to another guest, a market expert on really what's happening in regards to the dollar. There's an amazing thesis that this gentleman has, based not only on years of experience, but also the practicality of him actually, executing in markets on a consistent basis for the past few decades. There's been an original thesis that I have had in some capacity, and we mentioned maybe about a week or so ago, again, I feel like we keep saying that, where, hey, we did want to see some yen strength, but along with yen strength, we also, of course, have been keeping an eye on the S&P 500, which since the low of March 26th, I think, March 26th, we hit a low on the S&P 500, we have seen a pretty significant rebound. So we're going to take a look real quick at the S&P 500, see exactly what's happening in that regard, exactly why the Japanese yen has had a pullback after a pretty large pulse to the upside this week. But more or less, I would love for you guys to get, a very solid idea as to, the overall perspective of the dollar, and not only the dollar, just the economics behind it and the movement of capital throughout this time right now in global markets, where you have negative yields all over the place, you have money printing. It's really hard to keep grasp of everything that's happening. So I have someone here that I've been admiring for quite some time, Brent Johnson with Santiago Capital, 10-year vet at Credit Suisse. He also manages a wealth fund that, again, does a little bit more of a focus on dollar and dollar strength. Brent, I appreciate you so much for being here on the channel, my man.
Happy to be here. Thanks for the invite.
Yeah, no problem. So the first thing, again, people are quite confused as to why we have had this resurgence of capital in the S&P. We just had another print today on unemployment claims, an additional 3 million folks. So now we're at 33 million people unemployed at the moment. We're going to eventually potentially cross the record of the 1933 unemployment claim at 24%. Yeah, again, that's just my perspective. Why are we seeing this initial run? Are people moving ahead of the Fed on this idea of money printing and stabilization, or are people just actually optimistic about what's happening in markets? Is this speculation?
Well, I think it's a combination of a number of things. So what we had, let's call it back in March, right? In late February and early March, we literally had, it's a panic. There's really no other way to describe it. And it was a liquidity panic. It was caused by the fact that this goes to my overall thesis, which we'll get to, but the bottom line is that there's a lack of dollars in the system. And there's a shortage of dollars. And when you get into a situation where you need dollars, no matter what, prices no longer matter. Fundamentals no longer matter. Yeah. Trends no longer matter.
Yeah.
All that matters is get me money, get me liquid, and get me cash, and get me in dollars, right? And so we had a panic to the downside, and a lot of it was also, in conjunction with the COVID outbreak and the locking down of economies and shutting down, not just the U.S. economy, but the global economy, which means the velocity of money goes to zero. And all these things kind of converged at one point in time. And, I think it was what you said, the 23rd or the 24th of March was the lows. And, that last day, the S&P was down 10% that day. And so, that's not normal. That's literally just a panic. And so I think it overdid it a little bit to the downside. So I think it was natural to get a little bit of a, panic back up.
True.
But then what's been kind of amazing is after that initial 10%, so it dropped 10%, I think, on the 24th, and it was up 10 or 12% the next day.
Right. And
then over the next 3 weeks, we've gone up another 20 or 30%. So now I think we're down 15% for the year, but it's had a 30% bounce from the all-time low or from the March low. And I think that second half of that initial part of the bounce, I think, was just the panic back to the upside. But then in the last, call it 3 weeks, I think the central banks have just come back and just flooded the market with liquidity.
Yeah.
And I think a lot of people are front running, for lack of a better word, more expectations of even more central bank action. And so I think that's why the dollar's backed off. I think, people have, started to think, well, maybe the economy is going to open up a little bit sooner than initially thought. And this is the thing in markets, when things get really, really bad, they don't have to get better for markets to rebound. They just have to stop getting bad. Does that make sense? So like in March, it was literally a panic to the downside, and people were anticipating just absolute Armageddon. And so when things are just bad, but they're not Armageddon, that gives you potential for a relief rally.
No, 100%. Basically, you're saying, yes, at some point, like when the market is actually being affected by true blue lack, again, of market liquidity, actual economics, like no one's outside, consumer spending is completely, gone at that point in time. You have the market of being affected rationally. My thing is, I get the idea of, hey, yes, things were bad, but now we've somewhat subsided, right? I mean, there's less panic. But isn't it just the case that the market has not restabilized in regards to the actual economy, right? I mean, like we just spoke about, no one's out here, in my city, you're all the way over there on the West Coast, no one's doing this. Rebound to me seems a little bit not only superficial, but just illogical in regards to markets not really aligning with what is truly happening. Are we forecasting that, hey, yeah, at some point eventually things are to go back to normal? How do we price in, or how do we really know how long social distancing is going to happen, and then the cause of social distancing in regards to how that's going to affect the actual economics of the U.S.?
So a couple things. So I think I still think, and again, long term, I think we're going back to the all-time highs and exceeding the all-time highs, going to make new highs in U.S. equities. Let's call it over the next 2 to 3 years.
Yeah.
But I think probably, between now, let's call it the next 3 to 6 months, we're probably going to go back down and retest those lows.
Okay.
Or at least have another, maybe not those lows, but down another 15% or
exactly.
something.
Yeah.
And have a little bit of shake the tree one more time, so to speak, and kind of shake out these loose hands that have kind of picked up some of the pieces in the last month. But I think, part of my thesis is that equities, U.S. equities, now I want to specify U.S. equities, I think they're going to divorce themselves from fundamentals. I think they're going to divorce themselves from price to earnings ratio. And I think valuations are going to go through the roof. And I think they're going to go higher, not because things get better, but because things get worse. And what I mean by that is I think we are in a global recession, a global slowdown. But the money has to go somewhere. When you get a liquidity squeeze, what little liquidity that there is going to go where it gets treated best. And I think on a global basis, with the U.S. being the global reserve currency, with us having the deepest and most liquid markets, and with, I think, what's going to happen with the rest of the world coming under severe pressure due to their dollar-denominated debts, I think that money is going to get squeezed into the United States. And when it gets squeezed in the United States, I think it's going to find its way into the U.S. equity market. Gotcha. And that squeeze is going to push equities back to their all-time highs. Again, not because the globe is expanding, but because it's squeezing and that liquidity has to go somewhere. Yeah.
So basically you're saying the U.S. is so safe and so secure, people are going to look for that safe haven. So as we all know, right, when there's times of crisis, you have your safe haven currencies like the Swiss franc or the Japanese yen. You're saying once those guys ease off a little bit, you should see more repatriation out of those countries back into U.S. equities, global markets, things of that sort. Is that kind of the idea?
I believe so. And the other thing I always need to make this clear is that if you just analyze the United States in a vacuum, the United States is in absolutely horrible shape.
Right.
I'm not going to deny that.
Yeah.
But when you put it up against everybody else and you have to pick one of them, I think we look the best out of all of the bad choices, right?
Right.
And so, the cleanest dirty shirt, and I kind of hate that analogy, but that is kind of what it is. Global capital, big asset allocators of capital can't go to cash. You as an individual, me as an individual, maybe a smaller trader, we could just go to cash and sit on the sidelines.
True.
Big pension funds can't go to cash and sit on the sidelines. Endowments can't sit on the sidelines. Big hedge funds are not just going to go to cash and sit on the sidelines. They're going to put their money somewhere. Right. And when that capital starts to get allocated, I think over the next couple of years, I think the majority of it's going to find its way to U.S. assets. I think that's going to push up the U.S. dollar, and I think it's going to push up U.S. asset prices.
No, I totally get it. The interesting thing about all of this is there has been a massive amount of quote-unquote stimulus, QE, that a lot of Americans have just gotten that's now in the money supply. A second ago, you mentioned there was a lack of dollars. Now, that's not really maybe the case anymore, at least on the consumer level. How do you think that has set us up? You've been in markets for such a long time. You have never seen direct-to-consumer inflation. Back in 2008, right, we had a tremendous amount of inflation, but it went straight towards the banks. But now we are literally putting money in Michael Pinto. We were just speaking with him earlier this week. We were putting money in people's mailboxes. So what do you think that's going to do in terms of the fundamentals? And how's that going to fundamentally change our markets? Or do you think that it's just, hey, this happened, it was something that just gave us a little bit of a boost, and now we're moving past that? There is a lot more money on the Fed balance sheet, right? I mean, there should be some type of cause and effect here. Do you think the effect is only a positive one if you're thinking that markets are going to eventually rebound and head back to all-time highs?
So there's a couple things there, and you touched on a couple things that are very important. I think when you're considering this stuff, inflation, deflation, capital flows, no capital flows, cause and effect, the first thing you have to consider is where are you located. In other words, we're in the United States. So when I say we, if you're in the United States and you're a dollar-denominated investor, then it's different than if you're in Brazil and you're a Brazilian real investor, or if you're a Canadian dollar investor, or if you're a yen investor. And so and then, the cause and the effect, I think what a lot of times people get mistaken. Well, let me take a step back for a second. First on, plenty of dollars available. In the United States, there's plenty of dollars available, but outside the United States, there's a severe dollar shortage. And and it's because they've borrowed so much in US dollars, and it's because the majority of world trade takes place in US dollars. But if it's not your natural currency, the only way you get it is you have to sell something to get those dollars.
Right.
Or the United States exports those dollars because we're buying oil or whatever it is.
Right.
And they can't create new dollars outside the United States the same way that we can create dollars inside the United States.
Wow.
And so it's that lack of supply outside the United States that's causing the majority of the problems. Now, let's go back to cause and effect. I think what a lot of people misunderstand, and where they get this messed up with the weak dollar versus strong dollar, or inflation during deflation versus deflation, is a lot of people will read a book, or they'll go on some podcast, or they'll see some documentary that talks about they printed all this money and it caused inflation. Well, that's sort of correct. And so they get a little bit of truth and they latch onto it. But the problem is that the printing of the money that the Fed is doing now, that's the effect. The cause is the lack of dollars. So a lot of people are thinking they print, that's the cause, and then the effect is that the dollar gets weaker. It's the opposite. The dollar gets stronger, it causes velocity to slow, it causes the economy to contract, and so then the Fed responds to that contraction and they print money. Wow. And so the reason that we're not seeing high levels of inflation yet is the Fed is just trying to plug the hole of the economy going down the drain. They're not adding to the liquidity, they're just replacing the liquidity that's drained out. Wow. And so my opinion is they can print a lot more, because the demand for the dollar is so high, both inside the United States and outside the United States. The Fed can print more than any other central bank, and it won't negatively affect the currency the same way that Japan printing the yen or the ECB printing the euro will.
Yeah.
And so while this will end in inflation, I think that's a couple of years down the road. And to your point, when they actually start getting it into individuals' hands, that will help, as opposed to just giving it to the banks.
Right.
But with COVID and with the economies being shut down and with markets trending down, I think more people are worried about getting their next paycheck, not where they're going to spend their next paycheck. So that's a deflation. When you're worried just about keeping your job and getting that next paycheck, that's a deflation.
Yeah. Inflation
is when you get your paycheck and you can't spend it quick enough because you think the value of it's going to go down. I think right now people are very happy to get those checks. If they have a job, they're very happy to have it because they know a lot of people are out of work. So, right. Again, that's deflation. We'll eventually get to the inflation, but I think we have a ways to go.
So you're saying the effect is an increased balance sheet,
yes.
But then you're following up with saying that an increased balance sheet has no repercussions, right? I mean,
not yet. No, it does. It does have repercussions.
Okay.
But again, if you're just looking at the U.S. in isolation, it would. But if you're looking at it compared to there's dollars are demanded outside the United States as well. So even though we're printing, in a normal world, that would make it lose its value. So maybe versus gold or some other, hard asset, the dollar will lose. But if you're talking about the dollar versus the yen, or the dollar versus the euro, or the dollar versus the Brazilian real, just because we're printing doesn't necessarily mean the dollar is going to go down. If they're doing it even more, or if the demand for their currency falls more than the demand for the U.S. currency falls, the dollar price can still rise.
Right.
And so, because on a relative basis, there's more demand for the dollar than there is other currencies.
No, I mean, I totally agree with you that the U.S., if anyone is positioned well to come out of this, it's the U.S. We were the closest to, that normalization of rates, right? I mean, we stopped QE back in 2014. We saw the effects of that in terms of strengthening the dollar. You can go look at that. I'll put a chart up. 100%. You have Japanese. They're printing out of control. You have Europe. They were still. They just eased off of their money printing back right around the time Draghi left. So I totally agree with you that the U.S. is the best position. It's just a very interesting. No matter where you stand, it's. Yeah. It's really amazing to think that we can increase our balance sheet by $2-3 trillion and think that we can just go back to normal in a month.
Right? In a month, it's insane. But think about it. Since they started this, since the beginning of the year, they've increased the balance sheet by almost 50%. They've started buying high yield debt. They've started buying. They've gone and done the repo facility. I mean, they've done all these just absolutely incredible measures, and yet the dollar's up for the year.
Yeah.
Right now, it's pulled back from its March high, but it's still much higher than it was at the beginning of the year.
Right. And so again, like you said, if this was economy class, this would be lunacy, right? But based off of all the extracurriculars, all the other variables, and like you said, not putting the U.S. in a box, it actually makes a little bit more sense in nature. So you have a thesis that you're really known for, and that, again, our audience isn't too familiar with, the milkshake thesis. I mean, I would love for you to kind of give us a little bit more of an explanation on the function of that and how you align your portfolio and, the trajectory of how you weigh capital and, actually trade in markets, how you align it with that thesis.
Okay, so the name, the milkshake theory, kind of gets its name from this movie that was about 10 years ago called There Will Be Blood. Okay. And it was about this ruthless oil baron who would just do anything to beat his competitors. And at one point near the end of the movie, he wants to buy the land of his neighbor because it has oil on it. And the guy won't sell to him. And he says, okay, I don't care if you sell it to me or not, because I'm going to stick a straw down on my side of the fence, but it's going to go over to your side of the fence. And I'm just going to, even though the straw's on my side of the fence, I'm going to drink your milkshake. Yeah. And the way, and I kind of related that to global markets or global QE, because in my opinion, it doesn't really matter who prints the liquidity. What matters is who captures the liquidity. So, after 2008 and the global financial crisis, all the central banks, not just now the Fed was the most aggressive, but all the central banks did all these, extraordinary measures. They printed their currencies. They injected liquidity into the system. And I said they kind of mixed this big milkshake of currency liquidity. But then in 2015, we started raising interest rates. And so we started kind of sucking that capital into the United States. Now, the straw that kind of sucks that into the United States, it is interest rates. Our interest rates are higher on a relative basis, but it's not just interest rates. The fact that we have the deepest markets, the fact that we have, a rule of law, and people will challenge me on that. And I'd say, maybe it's not perfect, but it's better than a lot of other places. The fact that we have tax policies that encourage capital to come here, that we have regulatory bodies that encourage capital to come here. There's the fact that we're the world reserve currency and the majority of trade takes place. All those things act as the straw, which in times of stress pulls capital to the United States. So it doesn't really matter to me where the oil is located or where the currency is located, because we're going to stick a straw down in there and we're going to suck it up into our markets. Gotcha. And I think that's what's happening. That's where the name comes from, and that kind of goes back to the point earlier about just because we're printing currency doesn't necessarily mean it hurts us, because doesn't necessarily hurt the dollar price. Because again, if everybody's printing but we're sucking all that capital in, it's going to help our markets and it's going to deprive the rest of the world's markets. So again, not so much important who prints the currency, it matters who captures the currency. And I basically think over the next couple of years, we're going to steal everybody else's liquidity.
Wow. And so basically you're saying the winner makes the rules, right?
Basically, yeah, right. And then the other thing I always like to say is people say, but that's not fair, or that it should be illegal. And you're right, it's not fair. Yeah, it should be illegal, but it's not. So you can either invest for the world you'd like to be in, or you can invest in the world as it really is.
Yeah.
And this is the way the world is. You don't have to like it, but just recognize it.
Right. So overall, based on what you're saying is, well, not particularly to that specific point, but I kind of want to back off and kind of just say, again, you seem a little more optimistic, right? So when people are claiming that this is the beginning of, the capitulation, you're not in really agreement to that. You think that we're going to see some short-term, pain, but then we should, get back to where we were before. Is that where you stand, so to speak?
I do, but I want to stress again, though, just because equity prices go up doesn't mean things are good.
Right.
I think it could just be because of a flow of capital. And then, the other thing that, this starts to get a little bit complicated, but, with the rise of I don't want to say China being the enemy. I don't want to take it that far, but there's, let's say the bifurcating of the closeness that we had, right?
Yeah.
And you're starting to see, with the trade deal and now with the COVID, you're starting to, and, some of the military stuff in the South China Sea, you're starting to see, there's a definite friction between the United States and China.
Right.
And we're starting to see these the desire for two global supply chains rather than one global supply chain, two separate supply chains. We don't want to be dependent upon China for masks, for an example, or maybe some, certain important industrial metals that we need for our economy or whatever it is. And, same for them as well. So, and in that bifurcating of supply chains, industries are going to have to be redeveloped in either our country or other countries that were friendly to us in order to do that. And so that comes in with the swap lines. A lot of people have heard about these swap lines that the Fed extended as part of the, bailout over the last 2 months. Because there was such demand for dollars overseas, the Fed would send swap lines to the ECB, Bank of Brazil, Bank of Australia, et cetera, et cetera. And then that's how they can get dollar liquidity. But the point I want to make is that over the next couple of years, as we have these supply chains split, and this friction between the China block and the United States block, or Russia block, however you want to look at it, we're not going to provide that dollar liquidity to China or to Russia or to somebody that we deem to be unfriendly. Now, if you're our friend and you're helping us achieve our geopolitical goals, then maybe we'll give you the swap line. But if not, we're going to take that liquidity away from you and we're going to use the dollar as a weapon. Yeah. And so I think the rise of the dollar as a weapon is going to play out in a bigger fashion over the next couple of years.
Right. No, that makes total sense. I guess, at the end of the day, again, optimism, I somewhat agree. I do think that there was a tremendous amount of stability. No one could really pinpoint the thing that was going to cause the recession, right? Because when it comes to the infrastructure of how markets were, again, structured, there wasn't really that too many holes. Now, again, a lot of people point to the bond market and, again, just the overall balance sheets of how it just isn't making too much sense. You have negative rates. How can you sustain? And then, again, outside catalysts could definitely drive U.S. markets down. We are, again, in a global economy. If we've been on a 10-year run, there has to be, at some point, a recession, right? And I'm not asking you in any capacity to predict it, when and where and why, but what is going to be the thing? If everything can't be so perfect, maybe this is the recession, right? Recession is called what? 2 quarters in a row of a downturn. Yeah. So you're saying, maybe based off of this, we go for another 10-year run. How much longer can we continue to see this market move?
This is pure speculation, right? And I wish I had a crystal ball. I don't. But the way I kind of see it playing out is that over the next couple of years, the U.S. asset prices go higher, not because things are good, but on a global basis because things are bad and because capital is flowing to the United States. I think eventually the U.S. dollar will get so strong, it will just wreck the monetary system.
Wow.
And in some form or another, they're going to have to devalue the dollar. Now, whether that's as some kind of a multi-country currency accord like the Plaza Accord back in the 80s, whether the U.S. unilaterally writes it down, I don't know. But I think what will eventually happen is the dollar will have to be devalued in some form back from its future high back to maybe these levels or lower. And when that happens and people are no longer rushing to get into the US and capital starts to flow overseas, then that will take capital away from the US. That will, and as capital leaves, asset prices will come back down. So that's when I think we have the recession or the depression or whatever it is.
Okay.
And again, we might even have a recession. You can have a recession with asset prices going up. It's hard to believe, but it actually can happen. It's happened before. but I think the really, really hard times for the U.S. are probably between 3 and 10 years from now, not in the next 3 to 10 months.
Wow. No, 100%. And I think one point that you just mentioned that may misconstrued you as like this all-time, long-term, forever bull guy. You mentioned that, hey, even if the U.S. is hurting from an economic perspective, yes, we still should see asset prices increasing in the U.S. because of the pain that people are going through and based off of the positioning that the U.S. is in general. So you're not someone just that organically is going and saying, hey, yeah, I think the U.S. is just this amazing, well-ran machine.
Right.
You're actually saying the U.S. is so well-positioned, it really can't fail at this point. It's the U.S. is basically, J.P. Morgan Chase. You know what I'm saying?
Too big to fail.
It's too big to fail. If the U.S. fails, then the entire global economy gets into a mess that could take a decade to get out of, is basically what you're kind of saying in so many words.
What I would say is it's possible for the whole world to reflate together.
Yeah.
It's possible for the U.S. to go up and the rest of the world to go down. What I don't think is possible is for the U.S. to go into a big recession and the rest of the world reflate and things be good.
Makes sense.
I cannot figure that out. Now, I guess anything's possible, but I think that's a very low probability event.
Yeah.
And so if everybody goes down together, I think the dollar is the best of all of them.
Okay.
And if we all go up, then I think the U.S. will be fine.
Yeah.
If we all go down, I think the U.S. will be best on the relative basis. And I just can't figure out how the rest of the world goes up while we go down. That's why I'm, in positioning and trading, I'm biased towards the United States right now.
Right.
Now, one of the other things is, this is not me trying to be the ugly American and saying, we're so great, the rest of the world is terrible. There's going to come a time where I'm going to flip this trade and go the other way. And I'm not going to want to have anything to do with the United States, and I'm going to want to buy emerging markets and emerging market currencies and emerging market debt. But I just don't think we're there yet. I think there's more pain to come before we get there.
Yeah. That should be you said something that should totally be your point, where everyone would agree with you, where, again, U.S. will rise when everyone else's rise. If everyone else's fall, relative basis, U.S. will do great. It's nearly impossible to see it where the U.S. is not doing well and everyone else is going to the top.
Yeah.
So we're about to close out. You were a new trader at some point in time, and I know a lot of my guys want to talk about some more newbie questions, so to speak. And, kind of just ask how you got into, finance, and just really, what was the catalyst that got you in, and, how do you love in the business at the moment?
Yeah, so it's funny because I always wanted to be in business and I always wanted to work in investments, and that's even when I didn't know the difference between a stock and a bond. I just kind of had in my mind that that's what I wanted to do, and I don't know why that's what I wanted to do. I just always did, and it's probably I grew up in a little town in Nebraska, and maybe it was because it was so different than what I was used to. And so, I studied hard. I went to school and I read all the books and I took the tests and, I worked hard and I kind of worked my way into getting a job. But and when I first got into this business, I just basically believed what everybody told me.
Right.
Because I thought my bosses, they must know everything because they're in these positions of power and they're making all this money. And, so I kind of drank the Kool-Aid, for lack of a better word, and just took their word for it. And about, call it 10 years into that, I realized maybe they weren't quite as smart as I thought, and maybe they didn't have all the answers, and maybe they just kind of lucked into those positions.
Yeah.
And, and maybe I should, question their answers more often. And I had this very kind of fortuitous meeting where some potential clients asked some relatively simple questions that I didn't know the answer to, but I figured surely my bosses would know. Yeah. And my bosses didn't know. And the fact that they didn't know these answers, and not only did they not know, they thought the questions were stupid. And it turned out that all these questions this was right prior to the global financial crisis. Wow. And it turned out that a lot of the questions that were asked in that meeting came to be in 2008 and caused many negative things to happen. Wow. And that meeting kind of opened my eyes. And I kind of, at that point, decided I was never going to I might not be right, but I was no longer going to be uninformed. So I kind of took it upon myself to question everything, to do my own research, to think for myself. And I think if I would have done that earlier in my career, rather than just accepting what my bosses were telling me, I may have been in a better position at the time. But so I would just say, listen to what your superiors say, take what they have into consideration, but they're not gods. Right. Right. It is important to question authority from time to time.
Definitely. No, that's phenomenal. I can see how that could definitely set you on a path of self-education, going through 08, seeing your boss is wrong, basically, and being like, okay, maybe I need to look and tap into some other resources. Stylistically, in regards to your trading, I know you're a little bit more of a longer term guy, but can you give me some perspective on what long term is, and maybe just a few of the factors that go into your analysis, just a little bit?
Yeah, so I'm a big picture guy.
Yeah.
I'm not looking at balance sheets and cash flow statements, and I'm not digging into the minutia of every K1 and that kind of stuff.
Yeah.
I try to, and I'm a kind of an amateur chartist. I look at big trends. I kind of think I look at the world from a big picture perspective of how I think things should be working. But then I think one of the things that I like doing best is getting a 10 or 20 year chart of something.
Yeah.
If you can find a big picture trend and a big chart that then coincides with kind of a short-term catalyst that you can either see in the market, then that's when I'll try to bet big.
Wow.
Right.
Yeah.
And so my typical trading time frame is anywhere from 6 to 12 months, I'd say.
Awesome.
In some cases like gold, I think gold's going to go up huge in the next 3 to 10 years, but I think over the next 3 to 6 months, maybe it goes down. So I have a position in gold.
Yeah.
But, and I'm always going to I'm planning for now, I'm going to hold on to that because I think we're going much higher. But it wouldn't surprise me because of some short-term things if it goes lower in the short term. So I'm always kind of weighing the long term against the short term. And if everything lines up, then I'll go big. And if it's if there's some short-term stuff that's conflicting with the long-term stuff, then maybe I'll size it down a little.
Got you. You incorporate in any capacity, because most retail guys are strictly spot. How much do you incorporate derivatives and options trading within, maybe in regards to hedging and things of that sort?
Yeah. So I would say that the majority of our positions, especially in my wealth management business, are kind of long-term. Like we've been long equities for years.
Got you.
But there's been several times along the way where I've hedged that exposure with options.
Okay.
And those options will be anywhere from, call it 3 to 6 months in duration. And maybe we'll sell them ahead of time. If we get into the money, we'll take some profits, or maybe we'll let it run. But I think the majority of our long-term positions are not options, are their actual individual positions.
Yep.
And then we'll manage exposure with derivatives around that. But we have a private fund that we run, and we have some big ideas that we think are going to play out in a big way.
Yeah.
And a lot of that is done with derivatives.
That's awesome. Okay. Oh, for that risk reward, basically.
Yes, that's right.
Okay.
That's right.
Awesome. Yeah. No, Brent, very much appreciate you, man, for coming on. Wait, last question, actually.
Yeah.
And this is one that a lot of guys have questions about. We would coin ourselves as probably more or less about 65 to 70% fundamentals, and then we'll take a look at charts for sure for timing, market structure. From a percentage basis, how much are you, again, looking into? Maybe not the balance sheets and all, but again, you have to understand the catalyst, as you mentioned. So you definitely...
So when I look at fundamentals, but on a big, like on a country basis, right? Or the fundamentals on a state basis or a country basis. So I do think like the fundamental drivers are probably the majority of my opinion.
Okay.
I certainly don't just go with it. Like the dollar is a perfect example.
Yeah.
Like I have a very fundamental view on why the dollar is going higher. And I have a number of fundamental catalysts why I think it's going higher.
Yep.
Sometimes the charts line up with that. Sometimes it doesn't. But if I had to choose between the two, I would go with the fundamentals.
Right.
But awesome. It's great when they all line up.
Awesome. Brent, my man, you just encourage a lot of our audience because, again, when you're starting off, you had the, you were blessed to be able to get in that corporate environment and actually see the people making the money with, I'm sure in some capacity you saw guys making bets based off of, fundamentals, based off of these long-term trade time horizons. And so you took a little piece of that. A lot of these guys coming in, man, straight off of, just trading from home, so to speak, they're just kind of going on YouTube and just seeing a bunch of guys marking up charts, a bunch of weird indicators on, and they're having a hard time believe it. So somebody that's been in the business for such a long time, it makes them feel a little bit better.
You just reminded me of one thing. So this is the advice that I'll tell you. And I have a couple friends. Well, I have a couple friends who are professional poker players, and I don't consider myself to be a great poker player, but I like to play. And the reason I'm not a great poker player is I like to play poker. And what I mean by that is the professional poker players play 15 to 20% of the hands. They wait for their spots, and then when they get a good hand, they bet big.
Yeah.
And the amateur poker players, they play every hand, or they play 70, 50, 60, 70% of the hands because they like to play.
Right.
But you shouldn't do that. You should only play when you have the cards, or you should only bluff once in a while, right?
Yeah.
And so I think if I had to say one of the biggest mistakes in trading that at least I know of and that I see other people is they just trade too much. And, unless you see a great setup, you just shouldn't trade.
Right.
But when you see a great setup, you should go big.
Yeah.
And so that would be kind of the last piece of advice I would give.
And a great setup can sometimes take weeks.
Months. It might take months.
Exactly.
But if you make enough money on that one trade, you don't have to trade for another year.
Exactly.
You can wait.
Awesome. Brent, I appreciate you so much, my man. Where can people contact you? Is there a podcast? Do you have a book that maybe people can follow up on?
So I don't have a podcast or a book or anything. I don't have a newsletter, but I have a website, just SantiagoCapital.com. On that website is my email and my phone number. People can email me. They can call me. If I have time, I will try to get back to everybody. Sometimes it gets a little hard. I'm pretty active on Twitter. So Santiago AU Fund on Twitter. You can send me a message. Again, I try to get back to everybody. It's really hard because I get a lot of messages. But again, you can send me an email, Brent@SantiagoCapital.com. And happy to try to answer any questions.
Awesome. Guys, you heard it from the man himself, Brent@SantiagoCapital.com. Brent, very much appreciate you coming on, my man. And again, if you have any questions towards us, or if you ever come out with a book, we'll be the first ones to have you on, to help you with any kind of promotion, all right?
All right. Thanks for having me.
No problem, Brent. Thank you so much, man.
All right.
Awesome.